Hello, everyone. Today is Tuesday, September 9th, and this is your 314 SMI investor update for the month. Fernando, how are you doing?
Doing okay. We had a pretty eventful month in the markets here, ultimately with stocks ending higher. So let's jump into the models here. The
Yeah,
ETFs.
yeah, absolutely. Let's start this month with the real asset allocation model, or ETF, RAA ticker symbol. And just to refresh everybody's memory, RAA it's a multi-asset fund. And so really we're rotating between 20 broad asset classes based on trend and then some volatility optimization in the background. And so the idea is that we're in this debasement world. You need to expand your 60/40 menu outside of just fixed income and equities. We get granular on the fixed income side, granular on the equity side, and then we have an entire sleeve of alternatives, including Bitcoin, gold miners, oil, energy stocks. All that stuff is included in our alternative section. So what do we do for the month of August? Pretty good month for the fund, up 1.7%, made new all-time highs for the ETF. ETF only came out on February 26th, but you got to continue to make those new highs as the time permits. So what drove performance this month? And you can see that these are the charts we show in each one of these investor updates. The left-hand side looks at the individual asset classes and how they perform for the month and how the amount of overall fund performance that each one of those assets drove. And then on the right-hand side, we break that into those large, high-level asset classes, equities, fixed income, alternatives. And the beauty of August was that every single broad sleeve within the model was higher. So equities higher, alternatives higher, fixed income higher. When you look at it on the left-hand side, what drove performance? I think this is kind of instructive and explains uh, some of the favorable characteristics of this fund and why we think it's a superior solution for investors over something like a 60/40 or just a risk parity fund or things like that. Is that gold miners were a big driver of performance this last month. And so you can see, yes, NASDAQ was a big driver of performance. S&P 500 it was as well. Gold was in there doing its work, and gold's not too strange of an asset, but we have gold miners broken out. And maybe you don't know this if you haven't been paying attention to that little space in the market, but gold miners probably the best performing industry within the S&P 500 year to date. They've been on a tear, and that was reflected. We had a small position in the fund, but it really drove a big part of the performance. So that was I think that's an interesting thing to highlight for the RAA and why we did well in the month of August. So let's go forward and see how are we positioned going into September. Not a ton of moves really within the model. This look here is just looking at, you can see the last 3 months, the weight within the model and how things shifted around. And so we came from July into or August into September. You can see the last day of July is the August rebalance date. Last day of August is the September rebalance date. And we were at 55% equities. We dropped that down a tick to 54% equities for September. The alternative weight comes down, interesting. Like the fund sold out of its energy exposure, reduced its commodity exposure, managed futures, which is like a hedge position, also reduced that significantly. And it reduced its gold a little bit. Gold's still an overweight, but it went from 5% down to 3%. And where did that weight go? It went into fixed income. And so you can see that for the first time in a while, you have a significant long-term treasury position within the fund. That turned out to be a good call. You can see uh, obviously we had the jobs report come here in the last few days, and everybody now is on this rate cut path. I mean, you had, Bank of America was saying no rate cuts. We've had all these banks and all these people on Wall Street saying Fed's not going to cut rates this year. At 314, we had the view that there were going to be 3 to 4 rate cuts in 2025. And I think everybody's coming to where we are, and that is driving down yield. So it was a fortuitous rebalance into the fixed income space for real asset allocation model, and September is off to a good start for the fund. Let's move on to FCTE. FCTE, like we've said for a couple months now, there is no sugarcoating. It's been in a slump. And so let's dig into that. Plus 0.9% in the month of August. That trails the S&P 500 by 70 or so basis points over the month. The trail's equal weight as well. So equal weight's been pretty flat over this period of time, which explains a lot of the underperformance for the fund because it is an equal weighted strategy. 20 stocks equally weighted based on quality and trend. Um, and so it wasn't the equal weight, it was just, stock selection not so great. And specifically within the fund for August, there was basically no tech exposure, very little big tech exposure, so to speak. The only big tech we had was Meta, and because of a rebalancing timing luck, we ended up buying Meta on the earnings spike, even though the fund was looking to buy it before the earnings report. And so it was a bad fill. Sometimes you get bad luck, and the truth is we've dug into the underperformance of the fund here over the last few months, and our view is that this is a string of bad luck that expresses itself in these new stock picks. And so that's our conclusion. And we're seeing September already show signs of turning around. So the new picks in September, four of the six are beating the market and beating the market quite significantly. After hours today, Oracle reported, and it's up something like 22% or 23% after hours. We'll see how those gains, if they flow through. Usually those moves don't hold all the way, but it's a good sign because Oracle was a new pick, and it tells us that I think there's a good chance we get off the schneid here with these new picks. What drove performance over the month? You can see in the charts, very similar look that we have to the RAE decomposition above. The right hand side is sector decomposition. You can see there just wasn't any tech to drive performance, or very little tech. We had financials that drove the performance that we had last month. Low volatility, a lot of low beta stocks in here, and so that was kind of the message. They're more advancers versus decliners, so the breadth of the strategy was okay, but it's a 20 stock portfolio. It can have periods of severe underperformance and periods of severe outperformance, or very rapid outperformance. And so you want to stick with it. It's a great diversifying strategy. If you're trying to diversify away from just so much S&P 500 beta, which is really what every other quality fund that's out there is really doing. It's just an S&P beta, Mag 7 beta. You need something else in your portfolio. This is where FCTE comes in, but you're going to have to deal with some periods where we divorce from the index. So that's the story. Let's see how September goes. Like I said, we're off to a good start with both the funds for the month of September. Fernando, do you have anything to add?
No, I think that's a good place to wrap up.
Okay, as always, you can reach out to us on the website. We appreciate everybody out there. We'll be back next month with another update.